The Crotchety Old Men podcast is not a registered investment, legal, or tax advisor or a broker-dealer. All investment financial opinions expressed by or on the Crotchety Old Men podcast are from the personal research and experience of the owner of the site and are intended as educational material. Although best efforts are made to ensure that all information is accurate and up to date, occasionally unintended errors and misprints may occur. Before you invest or make any investment-based decisions, consider your own personal circumstances. You should do your own research and seek advice from a financial professional.
Well, it's happy Thursday again. Thirsty Thursday if you really come here to learn and think and grow rich for yourself. But anyway, today's podcast, we're in the studio. We have, as always, my partners in crime. My main man, Paul P.C. Clemens in the house. And of
Hey,
course, and our crotchety old man, George Crumley, standing nearby in the studio. Welcome, gentlemen, to the podcast. P.C., what's going on?
oh man, the stock market is going crazy. My money's melting like the Wicked Witch of the West, and I need to get with you brothers because three heads is always better than two, which is definitely better than one, to find out what we need to do with our money.
Well, hey, we have nobody better to answer that question than our, our buddy Paul. George over there. George, help us,
Absolutely.
help us, George.
Help us. So what I do. I don't look. I take the coward way out. I haven't looked at my portfolio in about a month. Sometimes I get these tidbits on the TV and the radio that the stock market, the Dow is down and this is down. And man, I take the chicken way out. I don't look. That's all I can. That's my best advice.
I've been following that too, because I'm with you, George. Hey, man, I don't even want to see it. I'm not looking at it because anytime you look at that stuff and you hear people talk about buy the dip and all that, you know what? I don't even want to see the dip. Okay. So I'm like you. I don't even look.
Yeah, but in all seriousness, it goes back to some of our earlier recordings as far as strategy. You have to look at why you invest. Are you investing for income? Are you investing for long-term growth? Are you investing for retirement? And with that said, I mean that should be your overall strategy. So what the market does on a day-to-day basis really shouldn't affect that. There's it's traditional. I mean, that's why the stock market does. It goes up and down. That's exactly what it
Right.
does. So you have bear markets, so that's expected. But, just as it goes down, we expect it to rebound. So, sometimes you just have to be patient and kind of watch it. But I think overall it's you have to make sure you understand why you're investing and what you're investing in. Those are the kind of key things. If you felt comfortable and you did your research on why you're buying these particular stocks, that should not really change. Okay. So, but if you're doing speculative things, maybe that's a little bit different. But that's my point of view. What you guys think?
Well, to my when I look at my portfolio, I tend to invest in what I understand best, and that's commercial real estate. So for me, I look at those stocks, and as you guys know, and we pretty much have shared, I think, in the past, is that I focus primarily on stocks that pay me dividends, regardless of what happens to the volatility in the market. And mine is I have this notification system on my phone, and I noticed that all during the down swings and all that stuff of the market, almost every other day I'm getting a beam or whatever, letting me know that a dividend is being paid. So my portfolio, I did take a peek of it after the dust settled. I understand yesterday the market was up 600 points or whatever. Didn't look at that. But what I did look at is the amount of dividends I've earned. Uh, Not only just the past quarter, but the past year. And I was astounded that even with the volatility, ups and downs of the pricing of the market or what have you, I still receive dividends. So to your point, George, my investment strategy is for income, you know, but the income, the dividends just goes right back and buy more stock. So in essence, earlier when we were talking about buying the dip, in essence, I'm buying the dip automatically because on a dollar cost averaging basis, as I get paid those dividends, instead of receiving them as income, they're going right back and buying more stock. So when the dip comes, my dividends are still buying stock.
Now my
So
strategy is a little is similar, but a little different because I don't have a big pension to depend upon. So the majority of my dependence is on my Social Security. So I too am looking for money. I'm looking for payout. Um, and one thing that I've noticed since we started buying dividend stocks is it doesn't matter what the market's doing as long as you got dividend stocks and they pay out every quarter, you're going to get paid. So that's the thing that I invest in most often right now is dividend stocks. I'm 70 years old, and as we retire, you have a depreciation of income automatically. When you retire, so that just bolsters my income. And I've even bought stocks to where I can I can I can pad my money against inflationary times and that sort of thing, which you can do. You figure in the year 2030 they're going to lower the Social Security amount that you get by 6%. So I buy 6% or 10% more stock just to be able to cover that when that happens. So that's my strategy.
Interesting. Hey Gary, some on one of the things that we talked about is REITs. In fact, we did a podcast on REITs. So, isn't it true that REITs have to pay out 90% of their revenue in dividends?
that's true. That's right. That's
Talk a
mandated by
little bit
law.
about that.
Well, REITs, let me go back. REITs, for our listeners who may have not tuned in on the other podcast, is that the acronym REIT stands for Real Estate Investment Trust. Think of it like this. Real estate investment trust is somewhat like a mutual fund, but it operates quite differently. And to the point what George just made, that they have to pay out their dividends or pay out probably at least 90% of that. Okay. So to that end, when you look at a REIT, let's say for instance a hotel REIT. A hotel REIT is going to have pretty much all your major hotel flags, from Hilton, Marriott, Four Seasons, and you name them, your major hotel companies, businesses. So it affords you an opportunity to be in a commercial real estate game, even though you don't have maybe hundreds or millions of dollars to go out and buy one of these hotels or commercial property. What it does is that it enables you to buy a share in those properties by investing in those REITs. And so, as the REITs, some of them pay monthly dividends, mind you. And as Paul had mentioned, then there's others that pay your quarterly dividends. But at the end of the year, I mean, during the year, REITs are constantly paying out these dividends and stuff to the shareholders. So if you own one share of a REIT, you are now thereby an investor in that particular property, or investor in that REIT. And so whatever profits that come from that, they're going to pass it right on back through to you. And so what a lot of people, and to Paul's point, some people use those dividends as direct income. Okay, and that's fine because dividends are taxed differently. But for others who wants to utilize what we know as dollar cost averaging, those dividends that these REITs pay out to you can be reinvested and to buy more shares of stock. So, George, did I cover that?
Absolutely. And one of the things that comes to mind is opportunity. Okay, so the stock market is going down, up and down. Stocks are lower than they were a couple of months ago. So from a investor perspective, how do you guys look at the opportunity of buying more stock, therefore using what you say dollar cost averaging to your benefit?
Well, one of the things I say is that buy what you understand. Again, I go back to real estate. And while we're on this topic of real estate has been deemed and has proven over the years to be an excellent inflation hedge. All right. Inflation has raised its ugly head now to almost 8%. And so, what does that really mean is that 8%, your whatever we purchase as consumers is going to cost you 8% more than it did the day before. That's really what it means. Okay. And so, if you're investing in stock, you need to be investing in something that you look at the intrinsic value of what these industries are. I take a real estate again. Hotels have had a tremendous hit. I'm not investing in hotel REITs. I just use it as an example. I don't believe that they're going to come back to the level that they were pre COVID. The labor shortages are one obstacle. You have your supply chain shortages and things of that nature. That's another headwind, if you will. So yeah, while leisure and travel has increased, you're still going to have those two headwinds primarily, and which are uncontrollable and pretty much out of our control. So from that aspect, I avoid hotel REITs. But the ones that I do invest in, which is near and dear to my heart, and more importantly to my expertise, are those type of stores or REITs that we shop at all the time. I mean, there's few people that I know that doesn't go to maybe a Sam Club or a Costco or a Burger King or McDonald's or even a Best Buy at some point in time. So I look at these major corporations that are buying into those. Well, you have, when you look at what's going on with development, there's a lot of single family home development going on. There's a lot of apartment properties being built. So companies that either build those or sell to companies that build them, such as your Best Buys and stuff, their stocks are going up. So if they pay dividends, then I want one of those. And particularly if the dividends is equal to or greater than the inflation rate. So it's just a matter of doing your homework, doing your research, and finding out those stocks. And you can Google this stuff online. If you want to know how much dividend Home Depot, let's say, for instance, is paying, it's easy. You Google Home Depot, go to their website, either pull up their 10K form, 10K form, or their annual report. It's going to show you exactly where their profits are, what they're buying. And so all you do is just mimic that, and you buy shares of stock into. You can either buy shares of stock directly in the Home Depot and do it that way. But I think the safest way to hedge your bet, if you will, is to buy a REIT. So now you got every REIT, every company that maybe could be Home Depot's competitors, such as Lowe's and all the rest of them. So
Good point. But I just did some quick math. So if I buy an individual stock, say Coca-Cola, and I bought it 6 months ago for $20, and right now it's selling for. So I just bought one share, and right now it's on the market. It's dropped to like $16 a share. Well, if I go and buy another share today at that $16, I've just reduced my overall exposure on that stock because now my average cost is $18 for 2 shares of stock of Coca Cola. So here again, with your dollar cost averaging, you can look at this as an opportunity to not only benefit from the dividends, but if you've got some extra cash, buy a couple of these, buy a couple of your favorite stocks, therefore reducing your overall exposure. And then once it goes up, you make some more money. What do you think about that?
George, I'm glad you mentioned that. For an opportunity, there's a cost in everything we do. There's an opportunity to make that interest or on the dividends that we talked about. Now, here's the other opportunity. Here's an opportunity not you give up that interest as well by not investing. You take that same $18 that you just talked about. Now, that $18 could go up to 20, 25, or what have you. It could pay a dividend of 8 or 5% on that $18. Either way, you're going to make money on it and putting that $18 into that stock or that REIT versus taking that same $18 and go buying something, buying a soda pop or buying a pair of shoes or whatever. Okay, so now you miss the opportunity to make money on that money. So when you look at opportunity costs, you got to look at it, that pendulum swings both ways. Am I really want to give up the opportunity to possibly double that $18? Coca-Cola is going to go up. As far as I know, barring some scandal or something, people are going to still drink Coke. Okay, so it's going to go back up, and so there's no doubt about that. So that $18 could double to $36, and just using simple math, if the dividend is 10%, that's the $3.60 that you just made on that same $18 that doubled. Versus You're giving up that $3.60 and going buying something. Now you just lost that opportunity.
Yeah, we got to get out of that consumer mindset.
It's all about mindset, baby.
Yeah, it's all about mindset. Definitely, definitely. Hey, this has been great, guys, and it's good that we talk about, current events, because I'm sure this is what's on a lot of people's mind. Especially new investors. If you invested a couple years ago, you're probably understanding this. But if you're a new investor, say you just started investing in January, you're probably looking at the market and saying, "Hey, the market's not my friend," because as quickly as I put money in, I'm losing money. But it's a roller coaster, folks. It's up and down. It's going to be up and down. But check this out. If you look at history, there's been more up days than down days, and that's all we really want to be concerned about. But hey, it's something you have to look at when you get into the stock market. It's not all upside.
Right on that. Well, here's a tidbit before we wrap up is this. Everything you do without educating yourself is risky. So educate yourself. Okay. You want to, sometimes you can't always avoid risk, but you can mitigate it, and you can certainly almost eliminate it by just doing what we just said here. Educate yourself. You see her say it all the time. KEY. Keep educating yourself. PC,
Yes,
take us
sir.
away.
It's been a good day. It's been a good. We've had a good conversation here. One of the things that I learned or have learned for some time. We had a guest on that was talking about all the different things that go into his business and how important it is for us to recognize um, the holistic effect of everything. Everything is connected to everything, and we have to come to find out when we make a decision on something that's going to affect something else down the line. And is that going to be an adverse effect or is it going to be a positive effect? And it goes right back to what Gary was saying about the keys. As long as we educate ourselves, we can get more positive effects out of things than we can the negative.
That's all right. That's exactly. You're exactly right. It's about keep educating yourself, and we want to continue to keep bringing you these broadcasts. Hey, we're new on Instagram, Crotchety Old Man Podcast. Please follow us on Instagram. We're looking at doing some Instagram lives that we can take your questions live and answer some stuff so that we can continue to educate you. And as always, we're on your favorite podcast: Apple, Google, Spotify. So look us up, follow us, keep us tuned in because we're going to continue to bring you good information on a daily basis, on a weekly basis. So hey, looking for the crotchety old man. Hey, go ahead and take us out of here, fellas.
Well, me, I like to always try to leave you with a nugget or a quote of some sort. So here we go. When you walk with God, the impossible becomes possible. Until we meet
Hello.
again, see you next week, same time, same place. Peace.
All right.
Peace.
Peace.